upside. Remember, when it comes to trading and when it comes to investing, you want to be focusing on probability. You want to have a better assessment of how the market actually operates. And remember, the purpose of a market is to sell. So remember, when people are selling calls, they likely own the underlying stock. That means if you buy a call on Starbucks at 110 and they currently have the shares at 101, if you're speculating to that upside, the person who is selling that call to you likely owns the stock. And if they own that stock and the shares go to 110 and they have to hand you the stock, maybe you dump the contract, but they're going to make money. They're going to make money selling you the call, and they would make money from the appreciation in that call of the underlying shares. Roughly a 10% gain for them, plus the contract that they are selling to you. So I want to remind you that because it's very, very, very speculative for somebody to step in and try to buy a call and simply believe, oh, this is going to absolutely go to the moon, do the rebalancing. I don't want you to think this way. I want you to think a little bit more proactively and understand that you too, as an investor and as a trader, can take advantage of something by increasing your probability of success and focusing on the primary trade that we do at Flashpoint Elite on a very regular basis. Starbucks, as an organization, company tip, if we go to tip ranks, Starbucks is one of those very consumer resilient names. We continue to see people going out, spending money and buying. They're not dumping their Starbucks. People might be $30,000, $40,000 in student loan debt, but they're still paying $5 a day for their latte. And if we look across the board of the market, you have a lot of very good consumer analysts who are stating this stock's worth $104. It's worth $127. It's $131 from Bank of America, $125 for BTIG. And these are all very good analysts with their rating and their track record. With that, if this stock is currently at $101, then wouldn't logic suggest to you that it would be great if you could buy that stock at a lower price? And there is a way to make money simply by putting up a little bit of capital, picking a price that you are comfortable with, and trading around that number. And the way that we do this is with puts. Now, a lot of people might look at Bank of America right now, for example, or forgive me, Starbucks. Sorry, I'm reading as I'm talking. I'm going to look at the options chain really quickly. So the options chain for Starbucks, currently going out to August 18th, has the $95 put at $1.17. Okay, so let's take a real quick look at this, and let's look at a cash secured put. And then I'm going to show you this, and then I'm going to talk you out of doing a cash secured put, because I want to show you how much money you need to put up in order to do this put. On August 18th, the $95 put is $1.15. That means you need to put up $9,385 in margin to potentially make $115. Now, when you sell someone a put, you are selling them the right, but not the obligation, to sell you 100 shares of that stock if the shares fall under at $295 or below on or before the strike date, which is August 18th. You would need to put up $9,385. Probability of profit, 82.5%. But look at the return, a whopping 1.23%. Not very exciting. So rather than putting up $9,385, what you can do is you can look at Starbucks. You can buy, you can buy the $90 call, or put, the $90 put, and you could write the $95 put. Now, if you buy the put, that is your protection to the downside. Now, I want to just walk through a couple simple numbers. If you bought 100 shares of Starbucks today, speculating to the upside that this is going to be part of the rebalancing, you would be putting up $10,165 for 100 shares of this stock. Okay, if that's the case, what you can do instead is buy that put at 90, because if the stock falls under 90, you can't lose any more money. You are now putting up, instead of $10,165, you could put up $435 to make $65. This is a 14.9% return, 152% annualized, and your break even for this trade is $94.35. The shares are at 101. The probability of profit of this trade is $800. If this stock were to fall to $90 in the next month, you would not be losing $1,100 on paper the way that the Starbucks operates. You would be risking $435, a significantly different drop. But you also will have the opportunity to buy the stock at that level if you are a longer-term investor. The way that these options work is if it falls below $95, you're likely going to buy the stock because, again, this has that long-term, the long-term potential of Starbucks. You have analysts behind it. It obviously is a great brand and a great company, and this within an allocation model would be part of your growth and income portfolio. But if the stock moves higher because of the rebalancing, or the stock just moves higher because of momentum in the market, the value of the put spread that you sold will go down. So that 65 value today could quickly move to $15 in 3 to 4 days, or maybe even 2 to 3 weeks. If the stock goes up, the value of the put spread goes down. You can buy it back and take that capital. If the stock trades sideways for the next month and a half, doesn't do anything, you're going to make money. And if the stock falls, but it never gets under $95 on or before April 18th, you're going to keep all of that premium. So that's a little bit more of a midterm level way to trade this. And instead of speculating wildly, you can simply go in and sell the put spread. Now, the other way to trade this, which is a little bit different, is instead of maybe buying a stock because, again, another $11,000 in cost, you can do something that's known as a call spread. And with Starbucks, remember, the current share price of Starbucks is $100.42. So if that's the case, what you don't want to do is you don't want to put up $10,000 to do this. Instead, what you can do is you can effectively trade around using a call spread that is in the money. So rather than speculating to the upside of the 105 call in, say, August, you could buy the $95 call, which is currently $8, $800, but then you turn around and you sell a call that is at the $100 level. And I'm going to show you very briefly that by doing this type of trade, you have a really interesting breakdown here. Because the way that this trade is structured, rather than putting up $10,165, you can do this spread. Buy the 85, sell the 100. So you're buying in the money and you're selling at the money. And here you're putting up $363 to make $137. Your return on this is $37.70. Your break even for this trade is $98.63. Your probability of profit is 62%. Now, I know you're looking at this and you're saying, well, wait a minute, this isn't 100%, 300%, 500% gains. Let me tell you something. If you want to try to get those types of returns as an options trader, you're going to be buying things that have a probability of profit in the 10 to 15% level. You are buying a lottery ticket. If you are focusing on managing your risk and you want to speculate to the upside and you think that Starbucks is going to be one of these companies, and keep in mind, let's look at Starbucks' numbers. This stock has consistently found support down around that 96.77 level, or 97.66 level. It's coming off of that short-term bottom. This type of spread has a break-even of 97.63. Probability of profit 62.8%. And then if you use Option Profit Calculator and you analyze the potential of these trades, let's just set this up in a way that you can see if this stock trades sideways and does not do anything, it stays at $101 for the next 6 weeks, You're going to start off, yeah, you might be down if the stock pulls back to 101, but if it just stays above 101, you're going to make money. If it stays above 100, you're going to make money. If it stays above 99, you're going to make money. But what's nice about this is you can see ahead of time through the lens of no implied volatility change whatsoever. If this stock pulls back, you know exactly what your potential loss is. So if you set up a trade like this, you can see ahead of time what your stop loss would be. And my recommendation is that the stop loss should be about half of what the total upside return would be in this type of trade. So if that is the case, that would be at about the 15% level. So if this stock fell to $99 next week, you would be out $56. You have about a 15% loss in the trade, but you're out and you're disciplined about it. But if this stock just holds and continues to just putter along, time decay will turn what looks like a loss on paper ultimately into a win.